Good morning, traders. Welcome to the Bookmap Pro Trader webinar series. Today's the last day of the series, and we have Charles today from Pirate Traders. He does stream with us weekly. It is at today from Pirate Traders. It is at on Mondays at 9 a.m. I'm sorry. Yeah, 9 to 10 a.m. That's correct. And that's in our Discord as well as our YouTube. Okay, so you guys probably know who Charles is. Anyway, he is an ES futures trader, specializes in intraday two-way auction process of the S&P 500. And he's the founder of Pirate Traders, which is a community of professional traders, and is also here active in our Discord channel at Bookmap. Let me go through some of his links here. You have his YouTube, his Twitter, his website. I will put these into the chat if you want to reach out to Charles. He does offer mentorship and trading room, so you can reach out to him. Let me go through the disclosures, and I'll turn it right over to Charles. The general disclosure: all Bookmap Limited materials, information, and presentations are for educational purposes only and should not be considered specific investment advice nor recommendations. Risk disclosure: trading futures, equities, and digital currencies involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Okay, Charles, why don't you, I see you're sharing your screen. Let me get it up and running here. Just a minute.
Thank you for the lovely introduction.
Excellent. We're ready. Go for it.
All right, perfect. Good morning, everyone. So as Bruce says, I feel like the community is starting to get to know me a little bit. You guys got a decent idea of what I do and how I look at markets. But why not dive in a little deeper? Why not learn a little bit more? Let's get to know each other a little bit better. If you have questions, throw them up in the chat. Bruce will keep track, and then he is welcome. By the way, I'll just say, Bruce, you're welcome to interrupt me anytime if you feel like a question is pertinent to what I'm talking about. Otherwise, we'll save them for the end, and we'll go through those questions together. So why don't we start just right now, because we're looking at it. Let's just talk about what's happening in the market at this moment. So we had a gap up this morning. The gap up is a sign of momentum to the upside, so that is bullish to see. But we're not getting much momentum, are we? The market opened, it pushed, and now we've just been going sideways ever since. Just kind of letting these computers pick each other's pockets and trade the market up and down. So that tells us that we don't quite have that much momentum, and we will probably need to fill that gap, looking for buyers at yesterday's high, 42.15. If there are no buyers there, they might be waiting down at 42.12. And only if we do not have buyers at either of those locations, only if the market pushes down below there and then gets new sellers, will I start to get bearish. And the reason is because I use momentum as a signal for what is coming next in the market. I look at the market as a constant auction process, and there are signals that it can give me through the market-generated information, through the things we see in the software, that can give me signals as to what's happening. Having a spike up at the end of the day yesterday, having a gap up this morning, and having thus far a gap and go is all bullish signs. That's all signs of momentum, and I tend to assume they will keep the momentum going until the market specifically tells me. The market tells me that momentum is over. So like I said, to me, the only way the market could tell me that momentum is over now is pulling back down below this area down here near the overnight low and finding new sellers down there. Okay. Otherwise, we're either just going sideways up here at higher prices, or we are building up momentum to continue to the upside. So for a second, I've been, since the last time I did one of these, I've been working on my own personal project with Pirate Traders, which is I've been building out these workshops, these sort of interactive experiences where it's not me just live streaming and talking about what's happening in the market in real time. And it's not just pre-made content that you watch for educational purposes. It's a little bit of both. And I've been learning a lot, and it's been a process of figuring out what works and what doesn't. And I'm pretty excited about it. So today, what I'm going to do is just go through a couple of the slides from that workshop that I've created, just a tiny little sliver of it to give you guys an idea of what that process is and how it looks. Okay. So this is focusing on how you guys learn to read the auction process. Okay. So first and foremost, very important for traders to understand, the best you can do is just start where you are, use what you have, and do what you can. I am a believer that there is no reason whatsoever that anyone couldn't be successful at trading. That the limitations that you believe are holding you back, you don't have enough money, you don't have enough free time, you have too many other responsibilities, the market is just not behaving in the way that you like, whatever the case may be, that you think is the reason you don't have success in trading, I don't believe that's true. I believe there is something you could do in your process, a decision you could make to act differently that would get you a different result, and that different result would lead you where you want to go. So you just start wherever you are, use whatever you have, and do whatever you can. So the way that I learned to make sense of the market was through a system that I learned from someone named Jim Dalton. And the idea is that to basically become a successful trader, you have to build a strategy for taking trades. How do you build a strategy for taking trades? Well, first you have to separate out your market understanding and your self-understanding. So a market understanding is one's ability to read the market and get an idea about what it's going to do. What did my market understanding tell me this morning? Well, it told me with a spike up and a gap and go that the market is likely going to continue higher, that we have that momentum. It also told me that because we didn't just straight up keep going, because we've been going sideways so far this morning, we might not be ready yet, right? So I don't want to be bearish. I don't want to assume the market's going to go lower, but I also don't feel a need to jump into a long trade right here. I can wait for the market to come back and fill that gap and make a decision at the gap fill. Or even if there's no buyers there, I can wait and step in down here near the overnight lows where I can get in with very little risk and a lot of potential reward. So that market understanding is just one step in the process. What does the market generated information tell me, and how can I use it? The next step in the process is a self-understanding. Okay, so you have to get to know your own personality. You are a unique butterfly, all your own. And you have strengths, you have weaknesses, you have habits, you have biases, you have things that you fall victim to again and again and again, which are completely unique to yourself. And so until you can distinguish what are your individual strengths and weaknesses, you can't develop a system to work around them. So you have to first learn to understand the market, be able to read a chart and have it tell you what's happening. Then you have to get to know yourself and where your strengths and weaknesses are. And then when you combine those two, you can build out a strategy where you use the things you're good at in reading a market to know when to trade and what direction to trade. And you can use the things you know about your self-understanding to know what position size to use and when or when not to take the trades. And when you combined all that together, that's how you become successful. Too many traders that I run into are trying to put all their weight on a market understanding. They think if I can just learn to read a chart, if I just understood what all the little colors and dots and bars and lines, if I just knew what it all meant, if I was an expert, then I'd make money. Then it'd be easy. And that's not the reality of how it works. The reality of how it works is that understanding all the bells and whistles is just the first step. And if you can't get over understanding yourself and develop a system for working with your own strengths and weaknesses, the market understanding won't really do much for you. So this is something from Ray Dalio. If you're familiar with Ray Dalio, he was the guy who created what is now the largest hedge fund in the world. And he uses a very simple system for approaching every single thing in life. He calls it the 5-step process. To me, this is the process for success, both in life and specifically in trading. Okay, so you have to start with a goal. You have to start with a clear understanding of what it is you're trying to do or trying to achieve. You then have to identify and do not tolerate the problems that stand in the way of you achieving those goals. You then have to accurately diagnose what those problems are, particularly the root causes. A lot of times, a specific problem that you might be dealing with in life might not be as simple as it seems. There might be a deeper issue at play, and you got to get to those root causes. Okay? Then you have to design a plan to get around those problems. Whatever the thing is that's getting in your way, how do you get around it? And then most importantly of all, you have to take action. You have to do it. So you figure out what you want, you figure out how to get it, and then you take the action to do it. If you go through this process again and again, and then you fail, you just go through it again, and then you fail, and you go through it again, and you fail, and you go through it again. And little do you know, slowly but surely, you are on a path to betterment. Slowly but surely, you are getting better and better over time by just getting a little bit better at identifying the problem and designing a plan and forcing yourself to take action. This is my favorite of all of Ray Dalio's principles and the key to both life and trading. Pain plus reflection equals progress. If all you do is sit in front of the computer and push the buy and sell button and trade each day and ride the wave of emotion, you know, oh, it's such a good day, I'm making all this money. Oh, it's such a terrible day, I'm losing all this money. If that's all you're doing, and then at the end of the day, you're getting up and you're walking away, you are only experiencing one part of the equation. You are only experiencing the actual experience. If you don't take the time to reflect on your experience, to ask yourself questions about why you made the decisions that you made and how you can make better decisions the next time. If you don't go through this, then you will never get progress. And too many traders spend years just sitting in front of the chart every day, pushing the buy and sell button, and never really asking themselves why they make the decisions they do. Sure, I get it. The chart said a thing. Ooh, you saw that little node of liquidity in Bookmap, and you were just sure we're heading up there to get that liquidity at 26. So you're buying right now at halfback to get up there and get it, right? So what happens if it doesn't go up there and get it? What happens if instead of going up there and taking out that liquidity at 26, they just come back down and they fill the gap first? They do a little boop, boop, and then they come up for it. Well, you don't want to make that mistake the next time. You want to go back and analyze, why did I get long? What was I seeing? And how could I have positioned myself better for that to take place? It is only with that reflection that you will improve. All right, so we've got these cognitive biases, okay? Things like confirmation bias, self-serving bias, the affect heuristic, and the base rate fallacy. So if you don't know what these are, I highly recommend you jump into it and do some research. This is your brain. You can't stop it. Listen, we were hunters and gatherers throughout most of human existence. You were designed, your brain was built for one simple thing: fight or flight. When you are confronted with something that is scary, that is difficult, that starts to make your heart race and your pores sweat, and you just get so excited or fearful or whatever the case may be, there is only two things your brain can do: fight or flight. It is programmed to just go into this reactionary mode and function like a computer, just doing what it's supposed to do: get you out of there or fight to the death. And so as a trader, when you start to experience those emotions with your trading, when a move that the market makes you feel a thing, those are the mechanisms that kick in, and you can't stop it. You can't wish it away. And I can tell you from experience, just studying it won't make any difference at all either. You can be an expert in this stuff and it won't stop you from having to experience it every day. So what the process of being a trader is developing a system around these things. So confirmation bias is basically your brain will ignore information that contradicts what it wants to believe. If you're convinced right now that this is a gap and go and that the market is going to just straight up rocket ship to the moon today, okay, then you would probably be ignoring the fact that we've went nowhere since the open. You'd be ignoring the fact that most of the time today, okay, we can see where's there more TPOs in here. Most of the volume today, where did most of the volume trade? Was right here in this one spot. So even though you have the gap and go and you have the momentum, they're not ready yet. You're early. And being early is the same as being wrong. Okay? Also confirmed by looking at the Bookmap and the chop zone, the bot zone that we're in. We know they just keep passing it back and forth until they're ready to break. Now, if you were bullish and you were like, I think the market's going to the moon, you could make a mistake and get yourself overly long. And then when the market comes back down to fill this gap, you get squeezed. And then you have to short or you have to exit your long. Okay? So you don't want to be confused. You want the market to tell you it's bullish, but you also want to be able to see the contradictory information. You want to be able to see something that is different than what you believe. So it tells you how to play that in terms of trades. Self-serving bias, this is a thing where we tend to believe that when we have success, it's because we're smart, because we did the right thing. And when we don't have success, we think it's just bad luck. We go, oh, that was the market coming to get me. That was the universe trying to take me out. It's very bad for traders, self-serving bias, and we're very, very guilty of it. So you need to recognize, even if you were right, even if you made money, that may not have been the right trade to take. And if it was the wrong action to take, well, then you don't celebrate it. You don't repeat it. You do the right thing. And if you do the right thing, if you take the right action and you don't win money on this particular trade, who cares? Let it go. It is what it is. Okay, you got the affect heuristic, you got the base rate fallacy. There's about a dozen more of these. And the long and the short of it is you have to develop a system to protect yourself from them. So let's talk about how I approach the markets every day. It seems overly simple and people don't want to believe me, but this is it. Right here is my whole system. Charles, give us your system. Give us your entries. Tell us where to put the stop. Here it is right here, folks. All I do is ask myself these two questions. All day, every day, nonstop, again and again and again. On every time frame, I'm asking myself this question. What is the market trying to do? And how good of a job is it doing of it? So we could look at this morning as an example. The gap up and the gap and go tell us the market is trying to go higher. It's trying to keep the momentum going. But the fact that we've just traded sideways, as I've been discussing, is a sign that it's not doing a very good job of it. So we should still be bullish, but not overly bullish. We shouldn't fall in love with a long trade. Now, what if the market were to come back down? It were to fill the gap, and then it were to start to work its way down towards the overnight low. Well, now I'd be saying, what is the market trying to do? Well, it's trying to get a gap and go, but it's really not doing a very good job of it. We're back down inside of yesterday's range. So now I don't even really want to be looking for a long trade at all. I want to wait and see what happens. See if we start to find some new sellers down here. That's it. So all day, every day, I'm just asking myself, what's the market doing? What's it doing right now? Is it going up? Is it going down? Is it going sideways? And how good of a job is it doing? What are the mechanisms that are causing it to move the way it is? What are the signals that would tell me it's done? If it's trending, what are the signals that it's going to stop? If it's rotating, what are the signals that it's going to start trending? Speaking of which, this is good, good support here. So I think we're probably heading up to test the overnight high at 42.27. And then we'll be looking for new buyers up there. That's our next chance to answer the question. So what is the market trying to do? Well, it's trying to go higher. How good of a job is it doing? Well, if it can get above that overnight high and it can find new buyers up there, well, it will be doing a very good job. And we would assume it's going to keep going. If it were to go to that overnight high, it were to poke above and then pull right back down, well, then we would know, ooh, it's not doing a very good job, right? It's not getting that continuation higher. And then, okay, I'm jumping ahead a little bit here, getting a little overly complicated right away. But if it were to push above that overnight high, come back down, and then pass back through the opening price now, after having done that, well, then it changes what it's doing. It's no longer trying to go higher. It's now trying to fill the gap. And so then we would look for it to head down and fill the gap. That's getting a little bit advanced. Don't worry about it. But the long and the short of it is, it's really just those two questions. What is the market trying to do, and how good of a job is it doing? By asking myself that all day and looking at all the signals, I have an idea, a decent understanding of what the market is doing. The key to being able to be successful with the way that I trade, the way that I approach the markets, is to combine a lot of different pieces of information. So I've got to be looking at something that's bullish, something that's bearish, something that's neutral all the time. And they're constantly changing. Right now, this thing might be looking like it's neutral. And then all of a sudden, oh, no, it is bullish. Oh, wow, look at that, new information. So I've got to always be open to all of the information and willing to constantly change what I believe. So I want to have strong beliefs that are loosely held, so that I can constantly change my mind as soon as the market generated information starts to tell me something new. Literally 5 minutes ago, I thought we were going to keep going sideways. Now, because I see that we didn't get a bunch of icebergs smacking the market down, because I see that we're getting good solid support here, I think we're going to the overnight high. So I just changed my mind from being more neutral to a little bit more bullish, just like that. Took less than a fraction of a second.
Explain why, Charles, if you could.
Because beforehand, what was the market telling me? It was trying to go higher, but it wasn't ready yet. Okay? And I could see that because of the volume and the time being in this tight range. And I could see it because I was watching on the Bookmap the way we had icebergs on the lows and then icebergs on the highs. And it's just something I've observed. I call it a bot shenanigan zone. When it does this, it tends to just keep grinding around until suddenly one of those icebergs disappears. And you can see now there's no red icebergs up here. No red iceberg, no red iceberg. So that triggers a thought in my mind. Maybe we're free. Maybe we're ready to break out of this bot shenanigan zone that we're in. And so then I say, okay, well, if we're free, what's the most likely place the market's going to go? Right? We were talking about momentum. So if we're not going sideways anymore because we're breaking out, well, then we're probably going higher. So then the next thing I'm asking myself is, okay, if the market wants to go higher, where does it probably want to go? Where are the most participants putting their orders to take profits or their orders to short? Right there at the overnight high. They love an easily visible level. That's a candlestick right there. And so some guys are going short up here. They got their limit sell orders waiting. Some guys who've been going long in here have their take profit order right in there. Okay? So if the market's done going sideways, which oh no, maybe not. If the market's done going sideways, this is the most likely target because that's where the liquidity is waiting. That's where the next set of business will take place.
Yep, excellent. Thank you.
Okay. So next we'll talk about the auction process. I know a few people this week, a few of the other presenters have talked about this, so I'm sorry to bore the hardcore Bookmapians that have heard it again and again. And of course, members of the brigade have heard it 1,000 times. But I think it's important to understand. I think it's important to wrap your mind around, even in the modern world where a lot of the trading is artificial, right? A lot of the moves that the market is making each day are not actually genuine decisions of buyers and sellers wanting to take the market higher or lower. A lot of it is just computers doing lightning fast trades based on mathematical probabilities. So suddenly a thing happens, an event happens in the world, somebody says something, a news thing comes out, whatever, and then all these mechanisms have to correct because they weren't programmed for that thing to come up. And so we get these just very sporadic and unusual moves in the market where it constantly appears to be setting itself up to do something. It appears to be setting itself up to break higher or whatever. And then out of nowhere, it sells off and then boop, then it goes. And it does all these strange things. And so it's easy to say, well, the auction process doesn't matter anymore. It's not really about what market participants think. It's about the computers and the mathematical, probability that they're built on, the structure of that. I would disagree. Okay, I would say it makes it a little bit harder when it comes to looking for entries for trades. But understanding what the market is doing, it is still, to this day, always moving in an auction process. Okay? So let's talk about it. How does an auction work? Well, an auction process is a process of changing the value of an asset in order to get more people to want to buy it. So we'll start with a one-way auction process. Think about an art auction. How does it work? The auctioneer brings out a painting. He talks about the painting. He talks about the artist and all the reasons why this painting is great. At that moment, in the room, everyone is making their own decision about whether or not they want to buy this painting, whether it's worth the money or not to them. They're also deciding how much it's worth at that particular moment. How much are they willing to pay? So then the auctioneer starts the auction process. Okay. He goes, do we have, 1,000, 1,000, 1,000? Nobody puts up a paddle, so he lowers the bid. Do we have 900, 900? No one puts up a paddle, so he lowers the bid. 800, boom, a paddle goes up in the air. Okay. The moment that first paddle goes up in the air, that first person in the room, and it will be only one brave soul that will slide that paddle cautiously up in the air. That first one that does it, they begin the auction process. From that point on, it is important to note the painting doesn't change. The painting is exactly the same. 2 seconds ago, no one was willing to pay $900 for that painting. But now that one single person is willing to pay $800 for it, guess what happens to the other participants in the room? They begin to decide they're willing to pay more than $800. So they lift the bid from $800 to $900. All of a sudden, a bunch of paddles go up in the air. 9, 10, 15 paddles go up in the air at $900. So the auctioneer lifts it again. I have 900. Do I hear 1,000? Boom. Paddles. I have 1,000. Do I hear 1,100? Boom. Paddles. 1,100. Do I hear 12? 12. I hear 13. 13. I hear 14. Boom, 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 boom. As that auction continues to go up and up and up and up and up, less and less paddles go up. There's fewer and fewer people that are willing to pay for it. Now, they've all got their own idea of how much it's worth. They've all got their own limit of how much they're willing to pay. And you just get less and less people who are willing to pay this higher price until there's only one paddle left, right? It gets down to just two people. I've got 1,800. Do I hear 19? I've got 19. Do I hear 2,000? 2,000? 2,000. No one for 2,000. Sold for 1,900 to this gentleman over here, right? That's the end of the auction process. So you start with very little volume. You start with just one brave soul willing to pay 800. That person being willing to pay 800 makes everyone else realize, oh no, they get emotional and they feel like, oh no, I've got to participate. And so then they start to bid. That pushes the value. The painting didn't change, but suddenly now it's worth more than it was just moments before. That's that emotion of that auction process pushing it up and down. And so the way we think about trading markets is basically that as soon as that one auction is done, as soon as that first painting is sold, they just bring out an identical another painting, another share of the stock, another futures contract, whatever the case may be. They just pull out that next painting. Well, we literally just established 2 seconds ago, there's only one person left willing to pay this price. So then that auction process happens again to the downside. Same thing. People start to sell and sell and sell and push down until there's some brave soul that's willing to buy, and then the process goes back up again. So the market is constantly moving through this two-way auction process. What's important to understand is the painting, i.e. the share of stock that you're trading or the futures contract or whatever the case may be, that underlying thing is not changing. The value of it is not really changing moment to moment. What is changing? The perspective of the participants who are choosing to buy or sell it. Their opinion is constantly changing. And that a changing opinion is what causes the price to move up and down. So because of that, what we say is the price is just a advertising mechanism. It doesn't mean anything. It is just to get you to do business. So on the way up in that auction process, it's FOMO. It's the fear of missing out on being able to buy this stock at this lower price, knowing that you could have sold it at a higher price in the future if you had. That fear of missing that opportunity in that direction is what forces you to do business. On the way down, it's the same general principle, but the idea is that it's such a good deal, you don't want to let the deal pass you by. So in the same way that if a store has too much inventory, they got too much stuff and no one's willing to buy it, no one's willing to pay the price, what do? They have a sale. They lower the price and they put these big flashy signs out. Sale, 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 sale. Labor Day weekend. Pew, pew, pew. Right? They shove it in your face. We lowered the prices. We lowered the prices. Why do they do that? Well, because it causes you, who didn't want to buy that thing beforehand, to choose to buy it. Same way, fear of missing out on the way up, it's fear of missing out on the deal. It's saying, I don't really need a new mattress. My mattress is fine. But boy, if it's Labor Day weekend and they're going to give them away for 50% off, I can't let that deal go. Sure, I'm going to go buy a new mattress. That's the auction process. So the same thing is happening to market participants, to you and me, on whatever time frame we trade. If you're a scalper who jumps in and out of trades, in a matter of minutes, this auction process is happening to you over a matter of minutes. If you're a swing trader who trades over a matter of weeks, this auction process is happening to you over a matter of weeks. It is going up and down, and it's movements up and down, where it goes, what it does when it gets there, that is causing the next movement of price. So what tools do we have in our arsenal to understand this auction process, to understand where we are and, how to approach what's happening? Well, we use price, time, and volume. And it is the combination of the three, the order with which we look at the three, and how we measure them against each other that gives us this understanding. So the way that Jim Dalton teaches it is that price advertises, time regulates, and volume measures. What does that basically mean? If the market wants to go to a new location, so let's say the market is here, it wants to go here, and when it gets up here, it wants to do business up here so that it can keep going, right? Let's say that's what the market is trying to do. Well, what would be the process of that? Well, the first thing would be the price would push up to there, right? You'd see the market move to that level. What would be the next thing you would see? The market would start to spend time at that level. It would start going sideways up at that new level. Okay, well then what would be the next thing you would see? If it spent enough time up at that level, if people really wanted it to keep going, if there really were new buyers ready to take that auction on the next big move up, you would see volume. So that is what you're looking for. The market makes a move in price. The next question you're asking yourself is, how much time do we spend? Then once we start spending time, you're asking yourself, how much volume are we bringing in? Whether you're getting what you expect or not is your signal. So if you think, let's go back to today's chart and let's talk about it using today's example. So this move up yesterday, essentially, we'll call it from the breakout of the rotational area. Let me zoom in here. So this is excess. This is that momentum. Boom. We make the big move. Price takes us from where we were for hours and hours and hours, just going up and down yesterday, bidding and bidding and bidding. I want it, back and forth, back and forth, back and forth. We finally, at the end of the day, broke out and price went to a new location. Where did it go? It went right here to where we closed, 42.11. Okay. So then what did it do overnight? Well, it just went sideways up here at this new higher level. So it spent a lot of time. It spent the whole friggin' night from the time the market closed yesterday to the time the market opened this morning. It spent that whole time up here in this overnight range. Okay, great. Well, then the next question is, do we bring in volume? Well, actually, no, to keep it simple. That continuation of time is going into today. So imagine this is basically just being from the move up yesterday. That whole time, we've just been doing nothing but going sideways. Nothing but spending time up here and bringing in volume. So the more time that we spend up here and the more volume that we bring, the more likely the momentum can keep going. Okay? But here's where it gets interesting. This auction process is happening on every time frame. So bigger picture today, this is bullish, right? Because bigger picture today, this tells us the market is likely going to keep going. But intraday, over the last hour and a half, what has the market been telling us? Sideways. More. Look at this. Look at that high. They just want to keep chopping it up. So they're coming back down to bring in more buyers to come back up for that high. Okay. So that's where you can be getting different signals from the same thing on different time frames. Ugh, stop it. There we go. On one time frame, a signal is sideways. On another time frame, it's bullish. Why? Because within the last hour, we've spent very little time in the upper end of the range. We've been up and down and up and down and up and down and up and down. The volume's all over the place. If it's on a lower time frame, if we're talking about over the last hour, but if we're talking about over the last day or so, well, then it's a different picture. It pushed higher and now it's spending time and bringing in volume. So on one time frame, the auction process is all over the show and it's just so much uncertainty, but on another, it's just building momentum. So obviously this is happening over a monthly basis, over a weekly basis, over a daily basis. This auction process is always happening. Okay. So if we zoom out, let's just make this chart a monthly chart. So now we're looking at the market over a period of years right now, right? What has been that auction process? Well, they pushed the market up as high as they could and they had to pull it back, put it on discount. Labor Day weekend, 50% off. Get you some ES. And then they got that auction process going again. But they got it a little overbought up there once again. And they had to put that market on sale, bring it on back down to discount town. And it got so cheap, the market couldn't resist. They had to go buy more. And then we got that next big move again. And then we ran out of steam. Now, what happened this time? Well, previous times when the market ran out of steam to the upside and it pulled back down with price, we spent almost no time at all on that pullback. We literally just pulled right back and boop, kept going. Did it again. Barely spent any time on that pullback. Did it again. Barely any time. Did it again. Barely any time. But then what happened on this pullback? Boop. Pulled back and oh shit, we started spending a bunch of time in here. Did it again. Boop. Another pullback. Oh boy, spent a lot of time going sideways here. And what did that lead to over a longer basis? Well, that we didn't get another one of these. We didn't get another dip that just boop, boop, turned around and head right back up because we just kept spending more and more and more and more and more time. So on a longer yearly basis, there's an auction process taking place. But now let's zoom in a little bit. We'll put it on the daily candles. And now we can see that over the last few months, there's been an auction process. It's been going on. The market's been going sideways in a range for a few weeks, exploring new prices, coming back to test it, heading to a new location. Going sideways for a few weeks, exploring new prices, failing, heading back down, putting the market on sale to bring in those buyers. Doing that auction, breaking it out, back testing it, going to the new location, spending the time going sideways, on and on and on and on it goes, right? So this auction process is happening, sure, over the last few years, but it's also happening over the last few months. We can zoom in even more and see it happening over the last few days. The market was stuck inside a range, going sideways, and it finally broke out. So now the auction process is to the upside. It's a really important thing to understand. Balance leads to excess, excess leads to balance. So whilst it can be very difficult to know what is the market doing right now, the market is always doing one of these things. It is always either balancing inside a range where it's going up and down, or it has momentum where it's heading to a new location. Okay, one of these two is always taking place on every time frame. Now, the challenge is sometimes it can be difficult to know which is happening right now. And that's what we're doing. That's what we as traders are doing on whatever time frame we're trading. If you're a day trader, you're trying to understand today over this day, is it a day of excess where the market is moving to a new location, or is it a day of balance where the market is moving sideways? And that's what you're trying to figure out. Are you range bound or are you trending? This is the adoption curve. This is an important part of this process. So every new auction process that takes place goes through this adoption curve. Everything in life goes through this adoption curve. Any new technology that people interact with will go through this process. And it's a great way to give yourself an understanding of what's happening. By asking yourself, what is the market doing and how good of a job is it doing? The good of a job is, where are we in that adoption curve? Okay. So if let's say you're a swing trader who's trying to trade the momentum on the daily, if you're going long right now, well, then you're taking a terrible trade, right? Because you're late. You missed the move. As a swing trader, the only thing to do now would be to wait for the market to pull back and give you a better entry to buy at a cheaper price and get continuation higher, right? So on the adoption curve of the move the market is making over the last few days, we've probably already brought in a lot of the people that we're going to bring in. So we don't want to join the party as the last of them are getting in, right? We want to get in at a better location. So going long right now as a swing trader would be a terrible idea, because that auction process to the upside as a swing trader is probably running out of steam. We're probably getting less and less new participants at this point. But what about as a day trader, right? Well, as a day trader, we've still got a gap and go. We've still got momentum. We've left behind a poor high, right? So in terms of the adoption curve of whether the market comes back up to the overnight high today, we're still in there, baby. We're still bringing in more people, right? We still have more and more participants who keep stepping in, who keep the market coming back, coming back, coming back. So on that auction process, there's still momentum to get back up there and test that overnight high. Probably have to fill the gap first. So that is part of what I think about all day when I think about entering a trade. When I see what I think the market is doing and I feel I have an opportunity to take a trade, I try to figure out who are the participants. Always I want to enter the market as an early adopter, and I want to get out in the late majority. I don't want to try to be an innovator. I don't want to try to be the guy who guesses when the market is going to reverse and go the other way. If the market is trending, I just want to assume it can keep going and look for signs for when it's coming to an end. Okay? And then that tells me we're ready to go sideways rather than guessing when it's going to come to an end. And vice versa. When it's going sideways, I want to assume we're going to keep going sideways until I see those signs of those innovators stepping in for that breakout. Okay? You have to accept the reality that the market is random. It is random. Okay? What happens on a day-to-day basis, no one ever knows. It is impossible to know. If you understand the mechanism of how a market works, it is literally impossible for it to continue to do the same thing in a repeatable way. It must constantly change. So you have to accept, if you're going to be a participant who is going to interact with this market, that you are going to be interacting with a thing that is random. The only way that you can be successful in a random marketplace like this is by having some sort of way to make sense of that randomness. That is what we call thinking in probabilities. Using a mathematical probability structure and good risk reward to protect yourself from the randomness of the market. The basic premise is you can do everything right and just not be lucky. And you just have bad luck and you lose money. And you can do everything wrong and just get lucky and win money. Our goal is to differentiate which is which and do more of the right things and less of the wrong things, regardless of the outcome, because that is random. Or I should say, regardless of the outcome of any one single trade. So one of the big things that I have come to learn about traders, the more and more I try to help them, is that they have this wrong idea of what it looks like to be a professional trader. They think a series of trades as a professional trader should be like this. Win, 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 lose. Win, 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 lose. Win, 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 lose. Win, win, win. Right? That's what people think they should be doing. Every trade, winner, 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 winner. I'm right, I'm right, I'm right, I'm right, I'm right. But the reality is I don't know anyone that can win like that. Not in the real world. Not again and again for months and years. That's just not the reality of trading. The reality of trading is you're going to be wrong all the time. You're going to be wrong because you're going to misread things. You're going to be wrong because the market is random and it will just do something unexpected. You're going to be wrong because a myriad of reasons. Maybe it's something emotional. Maybe you didn't get enough sleep. Maybe you're having a fight with your spouse. Whatever the case may be. There's so many things that could lead you to being wrong. You have to accept that you're going to be wrong all the time. But that doesn't mean you can't make money. A real professional trader has a win rate that looks more like this. Win, lose, lose, win, lose, win, lose, lose, win, lose, win, 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 lose, win, lose, 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 win, win. Okay, that's more like what a real trader experiences. And what is that? That's a 50% win rate. That is only being right half the time. But here's where it gets cool. If you have a set of rules that you force yourself to follow and you never ever break them, and those rules require that every single trade that you took of these 20 trades had twice the potential reward as the risk, and that you risk the exact same amount in every single trade, being 2% of your account size, this would be 1 month of trading with a 20% return. 20 days, 1 trade a day, right half the time, and you got a 20% return. Let me just say that again, because I know some of you take 20 trades in a single day. Over a month, you can take 1 trade a day, be right half the time, half those days you're wrong, and still bring home a 20% return on your account size. How do you do this? By being disciplined and following your rules and not taking the bad trades, not taking the trades that aren't part of the system. The point of risk management is not to make you rich. This is what people misunderstand. You have to give yourself parameters that you require to protect yourself from losses. And sometimes those parameters will prevent you from making money. You might miss out on opportunities, or you might make less returns on opportunities, but that's okay, because the focus of risk management is to keep you in the game for the long haul, to bring you back tomorrow and the next day and the next day, because as long as you're in the game, as long as you're taking that next trade, it doesn't matter if you have a loser, because you know the next winner is coming. But that next winner won't come if you get taken out of the game. And that's why you manage your risk. And then, of course, you have to create a systematic approach to trading the markets. What do I mean by systematic? You have to have an exact way that you make decisions. Now, this doesn't mean that you always enter with a 10-point stop or something stupid like that. It just means that every trade you take, you approach it the same way. If you're taking a trade because you think the market is going to fill a gap, you always take that trade the same way. If you're taking a trade because you think the market is going to break the initial balance to the upside and keep going, you always take that trade the same way. You take the same trade the same way over and over again, because then what trading becomes is you versus you, not you versus the market. The market is random. It's going to do whatever it's going to do. When the market creates a gap, you don't know if it's going to fill the gap or it's not. What you do know is, what are your rules for trading it? When can you take a trade to fill the gap? When can you not? How often do your rules work out in your favor? You could just try and see. You can make the rules, you can do the trades, you can keep track in a trading journal, and you can literally see on paper how successful your gap trades are, or whatever the trade setup is. That is how you get better. Have an exact way to do it, measure the success or failure of that rate, make adjustments, and then move forward like that. Don't worry about the market. The market is random. It's going to do whatever it's going to do. What you worry about is you and your approach. Okay, and then just quickly to talk about the market profile. The market profile is basically the same thing as a candlestick chart. It just displays the information in a three-dimensional way. It shows us time, price, and volume at each level. Why? Because of what we've talked about, right? Understanding where the market is going, how much time it's spending there, and how much volume is an edge. Just to answer the quick question that a lot of you will have about my setup, 30-minute TPOs. I use time as my point of control. The levels that I pay most attention to is the settlement, the closing price of the previous day, opening price, half back, the time point of control, the value area, and the volume profile. Okay, so one important thing that I do want everyone to understand about trading is that whilst having an edge in life, having an advantage in life, is having some sort of edge over the people you're competing with, in trading, it is about having an edge over the randomness of markets. Once again, it is you versus you, not you versus the market. So one edge that I have over the way that I give myself some control of that randomness is, before the market opens every day, I make a plan for what I will do no matter what the market does. So let's take this morning, for example. I see the market is opening up with a gap up. So I'm saying to myself, the highest probability is that the market wants to keep going higher. Okay, how do I want to trade it? Well, maybe I'm saying I don't want to mess with it inside this overnight range because it will be too uncertain. So how could I trade that? Well, I'd either need to see a gap fill and then the market finds support, and I'd look to buy somewhere for a gap and go trade to the upside, or I'd need to see the market push above that overnight high, find support up there, and then get long for that gap and go trade. Or I'd have to see the market push below that overnight low, find new sellers here, and then I'd get short to start backfilling some of the weakness we've left behind. Okay? So before the opening bell even rings, because I know where the market closed yesterday, And where it's going to open today, I can immediately say, what is my plan? What's my plan if it goes sideways? What's my plan if it goes higher? What's my plan if it goes lower? What are the levels I'm looking at? Where am I interested? What will they tell me? These levels are not just random levels that I point to. They're levels where that auction process starts again. If we get above that overnight high, anybody who was shorting in this whole overnight range, anybody who's been shorting all day today, they're all going to have to make a decision up here. Get squeezed or add to it and pull it back down. So this is a very important level. Same thing down here. Okay? Same thing with where the market opened, and so on and so forth. So I make my plan ahead of time, and I know what are the possible outcomes. If the market does this, why would it do that? And vice versa. Next, we talk about self-understanding is about mapping your emotions. You need to understand that the emotions that you experience throughout the day are not something to be afraid of. They're not something to avoid. You don't want to try to bury your emotions. You don't want to try to shut them off. Instead, you want to use them as a way for you to learn about yourself, to learn about what your strengths and weaknesses are so that you can build an approach to work around them. If you don't know what your strengths and weaknesses are, then how can you improve? So the things you want to keep track of are the triggers, the thoughts, the emotions, the behaviors, the actions, the change in decision-making, the change in market perception, and the mistakes that you make. So a trigger might be, for example, if you try to trade options intraday, or a thought might be, I can't believe this is happening. I'm not letting the market stop me out. This time I'm going to be right. It might be an emotion. You might feel something. It might be a behavior. You might have a certain action that you take over and over again. So for example, let's say your problem is FOMO. Let's say the market starts to make a move and you just can't help it. You instantly want to push that buy button, instantly jump into it. You're terrible at waiting for a pullback. Well, how do you know when that happens? Well, you might feel an antsy, nervous sensation in your stomach. When you start to get that FOMO, there might be a physical feeling that you can feel. There might be a certain thought that goes through your head. Like every time you get that FOMO, you think like, don't you miss it. You have like a specific little phrase that pops up in your head. It might happen because of something that happens in the chart. It might always be that when you're watching the chart and you're looking for support somewhere, and then it finds it and it starts to go, you chase it every time, right? So if you first can map out what is it that's going wrong, then you can figure out, okay, what do I notice happens before that thing goes wrong? Then you can make a plan for what to do next time that thing happens. So the next time you feel that feeling in your stomach, you know not to FOMO. The next time that you see the market make that little push higher, you know not to FOMO. So on and so forth. You have to map your strengths and weaknesses to be able to make adjustments to them. There's also a different sort of stage to trading depending on where you're at in the process. And it's important not to try to rush. It's important not to try to get beyond your ability. So in the beginning, when you're first learning to trade, it's a mechanical, approach to trading. You need to do things in a very exact way. You need to have very hardcore rules that you force yourself to follow, and you do things in a very specific way. But the better and better you get, the more subjective you can start making your approach until eventually it becomes intuitive and you can just sort of act and make the right decisions and do the right things without needing to really be exact about it. Just kind of go with the flow. But if you try to rush the process, you'll never get to the end result. The common problems that most traders, the things that end up being the deal breaker that takes them out of this business for good, is the unwillingness to create rules, unwillingness to give themselves a structure they force themselves to follow, a failure to take responsibility, an unwillingness to admit their strengths and weaknesses and learn from them, and an addiction to random outcomes. Our brains are addicted to random outcomes. That is why gambling is so effective. That is why Instagram is so effective. That is why Twitter is so effective. We love those random results, right? Those random rewards. So you must take responsibility. You got to eliminate fear and develop with restraint. You have to focus on your attitude. Okay? The way you approach the market will always be more important than your analysis. Okay? The tools you use don't matter. How you use them is what matters. The solution is in your mind, not in the market. Don't waste time and energy focusing on the wrong things. If you spend years and years and years trying to learn how to trade with VWAP and you think it's VWAP that's the reason you're not successful, you're wasting your time. Your problem is with your self-understanding and vice versa. Okay? Understand where you're going wrong and work on those specific things until you fix them. Otherwise, so much time will pass and so much money will be lost just doing the same things again and again, expecting a different result. Another thing that you should focus on is your habits. You want to create good habits in trading. Doing the same things over and over again makes a thing a habit. Your outcomes in life are a lagging measure of your habits. Your network is a lagging measure of your financial habits. Your weight is a lagging measure of your eating habits. Your knowledge is a lagging measure of your learning habits. You get what you repeat. So repeat doing the right things every day in the market and you will get the result that you want. You only have to improve 1% every day. So many traders want to just read a book or take a course or watch a video and instantly make tons of money in the market. It doesn't work like that. You just learn a little bit every day. You work a little bit harder. You get a little bit better. And then over a period of years and years and years, you get to where you want to be. But it is a slow process. You must accept that. And then the very last thing that we talk about is anti-fragility. Anti-fragility is basically just the opposite of fragile. So if something is fragile, the more pressure you put it under, the more likely it is to break. Whereas if something is anti-fragile, the more pressure you put it on, the stronger it becomes. A glass versus a rock. Okay. So yeah, like if you think about a glass, the more pressure you put it under, the more likely it is to shatter. But if you think about like a human muscle, if you want to make a human muscle stronger, you lift a big heavy weight, which actually tears the muscle apart. But by tearing the muscle apart, it grows back stronger. So you want to become anti-fragile with your approach to markets. You want to build into your systems for how you make decisions, ways so that when things go wrong, you learn from it and grow stronger and your system gets better. Unlike fragility, which would be just making random decisions, because then as soon as something bad happens, your whole system falls apart. We talk about a setup called the one-time framing trade. That is an example of anti-fragility in a setup. Anti-fragility in market conditions is an ability to trade trends, trade rotation, trade breakouts, failed breakouts, whatever the market is doing. Anti-fragility in a win rate is using risk management to protect yourself from losses. Anti-fragility in taking losses is turning every loss into a lesson. Anti-fragility in dealing with fear is having insurance. So all of this that you saw today is just the bare bones, the bare minimum of what I talk about in my workshops. The workshop is intended to be an all-encompassing experience where I teach you all of the steps that you need to go through to learn how to become a profitable trader. And I teach you all of the specific tools that I use, being market profile, bookmap, and the market internals to make that decision. Okay. If anyone is interested in checking out the course, you can find it at piratrators.io/workshops. And if you sign up today is the last day of a sale where it is only $125. And anytime that you sign up between now and the next one starts in July. So anytime between now and then, if you use the promo code Bookmap, you'll get 20% off. So with that, we'll turn back to the live markets and some Q&A and see if you guys got any questions for me. Oh man, market's still going sideways.
Let's see. Looks like you answered Hector's question over in Discord, and not really any questions over here. Really great presentation, Charles. Some compliments in here. Yeah, I mean it gets down to the crux of it, and really well said, well presented. I actually have a bunch of questions for you, and while we wait for others, maybe. So one of the things that God, you said so many interesting things. One of the things about the auction process that I want to inquire about is so you were talking about this, what is the market doing, and how well is it doing it, and you went through that process in the live market, and how it changes. That was excellent. However, there's a higher time frame process, and you mentioned a little bit about it, and that is extremely important, and you set the tone of the day based off of that. And can you talk a little bit more about that auction process? So, for example, like you go maybe just go over you rehashed what you said earlier about today on the higher time frame. So for the day.
Yeah. So, okay. Yeah, I think I understand your question. So yeah, basically how I take it into account is I'm kind of always paying attention to every auction process on every time frame. So like bigger picture, when we zoom out and we look at the daily chart, there is what the market is doing over the last few weeks, right? Which is like it was going sideways in this range. It was just stuck, man. It was stuck like glue to the center of the range. Couldn't go higher, couldn't go lower, couldn't go higher, couldn't go lower, and it just kept going. So on that bigger picture, what is the market trying to do? It's trying to break out of that range. So there is a certain pattern that I would look for that would tell me whether it is successfully doing that or not. And so on that time frame, that's what I'm watching, and I'm asking myself that. Okay, so just to talk about it very briefly here. So often, if the market is going to break out of a balance area such as this, there are two behaviors that we would look for. The first is at some point, it will pull back and back test that balance area high and find support there. And if it does, it will then get a move that is at least the same size as the general range of the balance area. So for this one here, we would expect that the market is going to make a move if it successfully breaks out up into, the 4320 area, right? So what is the process that it goes through to do that, right? How does it tell me if it's doing it? Well, first it has to break out above the highs, which it did. Then it has to come back and find support. If it does, then it tells me it's making that bigger move. Okay. So if I'm now asking myself a question on a smaller time frame, if I'm asking myself like today, what's going to happen, right? That's what's happening over the weeks. What's happening today? Well, if the market needs to pull back down and back test that balance area high, right? If that's what it needs to do, that's a big move. There's a lot of potential money to be made on that way back down. So what is a signal that could tell me on the daily range that that's happening? Well, I went over them, right? Break the initial balance to the downside is about to happen. That'd be the first signal. If we hadn't have spent this long here, I would have said we had to get below that overnight low. But because we went sideways, again, things are changing. Because we now went sideways, because we created that poor high and didn't repair it in a when what should happens doesn't, this slightly increases the odds that we might need that pullback, that we might need to go lower today. Okay. So how do I use that information in my trading today? Well, if I have a limit order going long, waiting at that gap fill, because I've been bullish all day and I've been wanting to buy for that gap and go, maybe now I say, yeah, I'm going to pull that order. I'm going to wait and see. I could still get in at that same level, but I want to see what happens once we poke below and catch it on the way back up instead. So why did I think that thought? Because of first seeing that on the longer time frame, we'd gone too far and need to pull back. And then seeing on this shorter time frame, we can't keep going up. And if we can't go up, if there's no one left to push the market higher, they got to put the market on sale to go bring in those buyers. Does that answer your question, or did I make it
Kind,
more confusing?
kind of. I mean, you covered like the candlesticks on the higher time frame. I think the leap of there's kind of a leap of faith in there that a little more explanation would I thought would help clarify is some of these things read from a book on from Dalton about the auction process of a gap, or that it's high of day, low of day, and there's it was just it was kind of presented in a way that this is what is said in the book, but we know as traders you have to do your own studies and to then extrapolate that into your studies and then into a trading plan, because a lot of times I think traders one of the pitfalls is, well, I read that in the book and Dalton says that, oh, it's a gap, oh, gaps fill. No, why do gaps fill? When are they more likely to fill? It is an auction phenomena, and that's kind of where I was leading. Or
Yeah. So
high of day, like why is it emotional? You
yeah. So that's getting into more complex stuff that just takes a long time to sort of wrap your mind around all of that. Um, but yeah, that's what I would say. That's what I'm doing is I'm understanding where there are important levels on every time frame. What is an important level on the daily? What is an important level intradaily? What is an important level? You know what I mean? And I have an idea in my head of what I think will happen at that level and what that will mean for that time frame and for the other time frames. And just the more I do it, the better I get. And it really is building a skill. You know what I mean? So
yes,
another analogy to explain the learning side of what you're talking about is like, I always tell people the basketball coach who taught Michael Jordan how to play basketball probably taught 1,000 other kids who never ended up being as good as Michael Jordan. So reading the book, learning what the auction process is, where are the important levels, why are they important, what can you do with those? That's all great information. That's teaching you the game of basketball. But to truly become Michael Jordan, you have to put in the work, gain the experience, have the natural skill. All of these other things are part of that equation. So I feel like that's the difference. Is like if you read the book and it doesn't click yet, you just haven't put in the work. You've learned the info, but it hasn't sunk in. You haven't done the practice.
okay, yeah. I mean, it just it always bothers me to see traders say like, well, it's the initial balance, okay, or it's a gap fill, and these are volume profile strategies, uh, but they don't. It's not understood why, what's behind the initial balance. How is that any different from just another big volume event during the day, or high of day? Just
Yeah,
understanding the
you're
kind of
you're hitting it. Yeah, you're hitting it on the head. That's exactly right. The that's why my approach isn't what is happening in the market right now. Is there a gap fill? I'm going to take a gap fill trade, right? My
right.
approach is what is happening in the market right now? What does that tell me the market is trying to do? How good of a job you're nailing it. It's like I want to understand the story of what's happening right now. The signals that I see, whether it's a gap or whatever the thing is, those are just pieces of information for me to construct that story in my mind. But you're absolutely right. Understanding why the market is doing these things is the insight. The signals are just signals to gain that insight.
Right. Okay. And another well, more of a comment than a question, was about the auction process. What I really liked, what the paddles and the one way, like a painting is obviously a one way auction, and one paddle goes up, okay, that starts the process. Oh, other paddles start going up, and maybe there's FOMO or whatever. This just to mention something like this is where in what you mentioned was it is the behavior basically of these participants, that we are starting to realize in the auction process that is kind of guiding where this is going, and this is where Bookmap shines, because those paddles going up, you'll see it historically in the chart. Where those transactions happen, you'll see it in relationship to price. So that context is all there. Understanding how to read it and getting traction out of it is understanding this auction process in detail.
Oh yeah, and being able to see, when they're putting liquidity in and then spoofing it, right?
Yeah.
So now you can start to tell, is this a genuine auction process? Are they really trying to take the market to a new level, or are they just getting you down there to get you to do business so they can turn it right back up? I mean, you can literally see it happen in the chart.
Right.
Speaking of which, we just lost a bunch of liquidity. So obviously there's some sort of news event happening right now. So I'd expect some sporadic moves. Dipping back below the overnight low is bearish. But because it's a news-driven event and because it's a liquidation break, more important than the bearishness down is whether it rotates back up into that overnight range. So if we start to get resistance here at the overnight low, I'll get bearish. But I'm not yet, because this could just be a liquidation to bring it right back up.
Right. Yeah. I really really liked what you were talking about, the randomness and how that needs to be embraced. The understanding that it is your reaction to this, and having your rules and your reaction to your tools as well, not the tool itself, is what's important here. I did have a question on the how you use, and I guess we don't have to elaborate too much on it, but the distinction between your usage of volume profile versus market profile. You started to talk
Yeah.
about the time price opportunities and like TWAP and some of these kinds of things.
Yeah. So it's all the same to me. To me, volume profile is basically just a piece of the market profile, right? So technically what makes market profile different is just the TPOs. So that's just the letters. But that's basically just a candlestick is really all it is. It just is visually easier to see as letters. But yeah, I mean, it basically is volume profile trading, just with that extra added context, right? Volume just tells you how much business is happening at a certain level. By bringing in the TPOs, I can tell how much time is being spent there as well, which the two in combination are really the insight. There's nothing wrong with just knowing where the volume's coming in, but how you know what that volume is and how likely it is to continue depends on how much time. So it's really the same thing. And a lot of the principles are exactly the same.
Okay. Okay. Excellent. Let's see if there's any other questions in here. Waffles, I don't know what to say here, like too many ifs. Well, I think Charles is going through the process to bring down the ifs and to simplify it, and he has his own rules based on it. The Let's move on to Josh's question here. Hi, Josh.
Actually, hold on. I'm seeing his question. Let me just dive into this for a second.
Sure.
So the too many ifs thing is I get your point. Here's what I would say. If you want an exact way to trade markets where there's no ifs, it's like when the market does this, I go long, I go short, I put my stop here, I always do this exact thing. There is definitely a way to make money doing that. There's nothing wrong with that. As a matter of fact, every algorithm on earth does that every day. That's how they make money. But my edge, right? My advantage is in the what ifs. It is in my brain's ability to decipher all that information. So there was a point a few years back where I wanted to try to systematize my trading. I wanted to try to create an algorithm to just trade for me. Because at the time, most of the money I was making was from a rotational strategy that was very, very exact. And so I thought, let me just try to create this bot. And so I went through and I did this massive, all right, so we got new selling now below that overnight low. This is now a liquidation break with new selling, which is bearish to see. So that increases the odds in my mind that we need to pull back down and probably test the base of the spike up at 41.99, call it 4,200. So that is less bullish to see. If they were going to take the market higher, they should have just dipped below and pulled right back up. So those new sellers are a little bit bearish. what was I saying? Oh yeah. So the what ifs. So I basically went through and I calculated in a literal way all of the signals that I use. How often do they work? So how often when the market creates a poor high does it get repaired? How often does an initial balance break continue in that direction? How often does this? How often does a gap fill? How often does blah blah? I went through all these different setups and I worked out the literal mathematical probabilities of them, and none of them worked better than like 50% of the time. Most of them had 30% to 50% win rates when it traded it like a computer, like an algorithm in an exact way. And so then I sat there baffled and confused. Well, how is this possible that I make money every day trading these things, but yet when I trade them in an exact way, they don't work? What's going on? And that's when I learned that there is discretion taking place, that inside my brain, there is a capacity to choose when to listen to a signal and when to ignore it. And the only way my brain can do that is by combining those different pieces of information. So market profile might be telling me one thing, but the Bookmap is telling me another. By combining those two, I will end up with a better end result than just going off of the data on the one. Does that make sense? So the what ifs are actually what give me the edge.
Yeah, makes good sense there. Let's see. Josh is asking, it seems 4190 was a big level historically, liquidity at 4200 from yesterday. Maybe this combo can support coming up.
Um, yeah, no, I mean, I like 4190, but the problem is we haven't back tested it, right? How hard did the market have to work to get to that level? So they had to come from all the way down here. They had to turn the market around to work it all the way up to there. The idea that they're just going to be able to keep going forever, not as good, right? So that tells us, and that doesn't mean today, but at some point, they're probably going to need to come back and test that. Now, you notice the level, you know it's important. What does that tell you? If they come back and test it and you're seeing that support, you can take the trade.
Yeah, yeah. I think the way that I would answer it very much the same way that you did earlier about like, okay, see how the auction is starting to change. And you noted it a few different times. And therefore, it seems like it wants that liquidity and is going for it. So it's again the behavior. And answering your two questions will really help filter that.
Exactly. So what was the market doing this morning? It was trying to gap and go. It was trying to go higher. How good of a job did it do? It did not do a very good job, right? Couldn't even get to the overnight high. So now what happened? Well, now we pulled back down into yesterday's range. So what does that mean? It means the market is trying to pull back down and backfill some of that weakness we left behind. It was trying to do something this morning. The signal it could not do that told us it's now trying to do the opposite. And so now we're looking for signals that confirm that that's what's happening, which would be resistance and more selling.
Okay, excellent. One last question here. We'll end it on this, and then we've got to go. Could you explain how TV is asking if you can explain how you read the icebergs during liquidation breaks, basically?
Yeah, I would actually prefer to hand this over to you. Do you have any insights on that? On like if a market starts to randomly liquidate, is there any way to understand what's happening based on the iceberg,
The way
stuff that you see?
I mean, the way I use the icebergs is very. I mean, everyone does it differently. Scott Pulcini, for example, we had the webinar yesterday with him. He looks at that as the volume event, and then he wants to look at the order flow around that. So it kind of perks up his interest at that time, which makes good sense. Only if those icebergs are, meet a certain threshold. I'm different. I will look at specific levels, and then I look at the stops and icebergs as another confluence at those levels. Okay, so what are these participants telling me now? And we know the types of participants. The larger players are using icebergs. The smaller players are using stops. What is their behavior at these levels of interest? So if I see a lot of, for example, price comes down to an area of high liquidity and it gets filled, and I see a lot of icebergs, I'm very interested. But now I want to see the aggressors come in, and the buyers, and I want to see them starting to move the market, and then I can start to target higher liquidity on the offer.
And any specific insights on a liquidation, like when it happens super fast, like it's happening in a second's time? Is there anything that you just like gives you a quick insight, or you have to wait and see?
That's harder. Of course, like you look at your level, and yeah, I mean, I'd have to see some pretty, you know, distinct iceberg buying. Like it has to meet kind of a threshold, I think, or it just has to
Hmm.
be a lot compared to, and it's relative for me. It's not like Scott. It's relative for me. Personally, that's what I look at. If it's like, a few thousand, and for the day I've only had like, I've seen moves of like 100 and 100, 200, and then I see a few thousand, it gets more significant, for sure. uh, those are, I mean, you can still, the order flow principles apply. It has to. The aggressors have to come in to move it back up.
Hmm.
But it can be kind of tricky to trade that, and it's a bit more of a kind of, shot in the dark. Or with the volatility, you just, it's trickier, put it that way.
Hmm. That is how I do it, by the way, too. With a liquidation, it's generally a guess in the moment. If I want to trade it, I enter the trade, and then I have to just wait and see. I mean, you just don't know until
Yeah.
the next thing comes in, the next business starts.
Yeah, exactly. But if it's at a very specific level that there was a lot of buying previously, and price comes down into that area, and spikes below it, tons of stops, but you see aggressors, buyers above that area, I'm in,
Hmm.
and I'm looking for it to go higher. But that's the way I would look at it.
Well, speaking about it looking like it's going to go higher, to me, it looks like it's going to go lower.
Yes, I think you're spot on.
Bow, 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 bow. There it goes. Next one.
Excellent. Well, let's see. Any parting words of wisdom, Charles, and we'll wrap it up.
Yeah, I mean, no parting words of wisdom. You guys know me. I got this YouTube channel, Pirate Traders. You're welcome to come watch our free streams. We have a brigade membership. You can get the first hour of the day every day. You can stream with me to get my insights, get my analysis of what those scenarios are I think are going to happen each day. But ultimately, my advice to you would be just explore. Try lots of things, track your results, get better and better, and stay positive.
Excellent. Thank you very much, Charles, and we'll see you on Monday then.
All right. Thanks, Bruce. Have a good weekend.
Okay, you too. Bye bye.
Bye, everyone.